If you were born before 1966, 3 savings account rules that your bank is currently operating under have been quietly rewritten, and the combined financial damage to the average retiree who does not know about them is running between $4,000 and $40,000 a year, depending on which of the 3 is hitting hardest. Your bank will not explain this to you. There is no letter. There is no disclosure. There is no notification of any kind. The changes are legal. They are documented in account agreements that run to 40-plus pages, and they were specifically structured so that the people most affected would be the least likely to notice. Hey, I am Lana Maines. I break down the financial and legal facts that protect your money and your family in plain language so you actually understand them. I am here to bring you the kind of financial information that can genuinely improve the way you live day to day and protect what you have spent a lifetime building. So, if that sounds useful to you, go ahead and subscribe. We cover something like this every single week. Here is what most people assume when they hear about savings account problems. They assume it is a low-income issue. They assume that if they have a comfortable balance, a paid-off home, a pension, or Social Security plus some savings, they are insulated from this. They are not. For the woman living mostly on a fixed Social Security income, rule number 1 is hitting her hardest. For the woman with $80,000 or $100,000 sitting in a bank account she has held since the 90s, rule number 2 and rule number 3 are where the damage concentrates. This video is for both of you. I am going to tell you on every single rule exactly which group it hits and how. So nobody watching can say this does not apply to me. Start with rule number 1, the interest rate to inflation gap. Here is the misconception. Most people believe a savings account that earns interest is protecting their money. The number goes up each month. They see it. They feel secure. What they do not see is the number that is not on their statement, the purchasing power they are losing at the same time. Here is the actual rule as it operates right now. The national average yield on a standard savings account, according to FDIC published data, is below 1%. In practical terms, on a $50,000 savings balance, that is roughly $250 earned in interest over a full year. At the same time, the current inflation rate is running at 4.2% confirmed in government inflation reports. On that same $50,000 balance, 4.2% inflation means you need approximately $2,100 more this year than last year to buy the exact same things. You earned $250, you needed $2,100. The silent net loss on a $50,000 balance is approximately $1,850 every year with no notification. This is what that means for each group. If you are a lower income retiree with a smaller balance, the dollar loss is proportionally smaller, but your fixed income leaves you with no margin to absorb it. If you are a comfortable retiree with a larger balance, the percentage loss is identical, which means the dollar damage is larger in absolute terms and will compound more aggressively over the next 5 years. Your grocery bill feels heavier because it is heavier. Your savings account is not keeping pace with that weight. That is not an accident, that is arithmetic. And arithmetic does not care how carefully you saved. The specific procedural step here is this. Pull up the FDIC national rate cap tables, which are published on the FDIC.gov website. Search the term FDIC national rate caps and compare your current savings account yield to the current published average. If you are at or below the national average, you are in the bottom tier of available products. That number is your baseline for rule number 2. It is worth knowing that closing the rate gap does not require taking on any risk. Online banks and credit unions offer savings products that are just as federally insured as the account you already have, and many of them currently pay several times the national average yield. You do not need to move your entire banking relationship to take advantage of this. Most retirees keep their everyday checking account exactly where it is for the convenience of a local branch and simply open a second account elsewhere for the portion of savings that is not needed month to month. Same protection, same insurance, a meaningfully different return simply because the institution is not relying on your inattention the way a legacy branch account often does. One more thing worth knowing while we are on the subject of where your money physically sits. Most people assume FDIC insurance protects every dollar in every account they hold at a bank, no matter how much. It does not work quite that way. The $250,000 coverage limit is applied per depositor, per bank, per ownership category, not per account. If you have a savings account, a checking account, and a certificate of deposit all sitting at the same institution and the combined balance crosses that threshold, the amount above it is not federally insured. Retirees who have consolidated decades of savings at one trusted local bank for convenience are the group most likely to have quietly stepped outside full coverage without realizing it. The fix is simple: spreading funds across more than one federally insured institution or titling accounts differently to expand your coverage. But you have to know the limit exists before you can do anything about it, and your bank has no obligation to bring it up unless you ask. That leads directly into rule number 2, because what you find when you check that yield is only half of the picture. The fees are the other half. Here is the common misconception about banking fees. People who have held the same account for 10, 15, or 20 years assume their fee structure has not changed. They opened the account, they accepted the terms, and they believe those terms are stable. They are not. Here is the actual rule. Under banking regulations, financial institutions are permitted to modify account terms, including maintenance fees, minimum balance thresholds, and inactivity penalties, with a written notice period that has been reduced and in some cases delivered only through electronic disclosure. For account holders who do not use online banking, who receive paper statements, or who simply do not read 40-page account agreement updates, that notice is functionally invisible. Accounts opened before 2010 were frequently grandfathered under more favorable fee structures. Many of those grandfathered terms have since been renegotiated unilaterally by the institution. Take a woman named Diane. She is 71, a retired hospital administrator from Knoxville, Tennessee. She opened her primary savings account in 1994 and had held it at the same regional bank for 30 years. Last spring, Diane sat down with her year-end statements and added up something she had not tracked before. The monthly maintenance fees on her account had increased 3 times in 6 years. The minimum balance required to waive those fees had doubled. Because her balance fluctuated slightly in the months after her husband passed, she had incurred the fee every single month for 14 consecutive months without realizing it. Total cost was $412 in fees alone. Combined with the inflation gap on her balance, her real net loss for that year exceeded $3,000. Diane did nothing wrong. She saved. She stayed with her bank. She trusted the institution. That is what the fee restructuring is designed for. Here is what that means for each group. For the lower income retiree, fee waiver thresholds are the critical number. If your balance dips below the new minimum even once, the fee triggers, and on a fixed income you may not notice for months. For the comfortable retiree with a larger balance, the maintenance fee itself may be waived, but the inactivity penalties on secondary accounts and the reduced interest tiers on higher balances are where the loss concentrates. Here is the catch that costs everyone. Most people have not requested a written fee schedule disclosure for their specific account in the last 3 years. Not the general brochure, but the actual schedule attached to their specific account number. That document exists. Your bank is required to provide it. Most people have never asked for it. Right now, if you have your most recent bank statement in front of you or can pull it up on your phone, look at the line item labeled service charge or monthly fee. If that number is anything other than 0, write it down. Multiply it by 12. That is your annual fee drain before the inflation gap is applied. The number you are looking at is the starting point for rule number 3. And rule number 3 is where passive loss becomes active exposure. It is also worth understanding why banks are legally allowed to do this so quietly. When you opened your account, you signed a signature card that referenced a much longer account agreement, a document most people never read in full and were never expected to. Buried inside that agreement is a clause giving the bank the right to amend terms going forward as long as they meet a minimum notice period. That notice period has shrunk over the years, and in many agreements, it can now be satisfied by a message inside your online banking portal rather than a letter in your mailbox. If you do not log in regularly, you may never see it. That is not a loophole your bank is hiding from regulators. It is a term you already agreed to in writing, possibly decades ago, without knowing what it would eventually be used for. We have not gotten to the part that catches even the people who did everything right. So here is what I want you to do. Separate from all 3 rules we are covering today. The exemptions, the breaks, the refunds most seniors already qualify for but never claim. I have put them all in one place, state by state, form by form, so you do not waste hours digging through government sites. Everything is laid out fast and simple, so any senior can find exactly what applies to them. No matter what state you are in, there is money you are leaving on the table. It is called the Senior Exemption Playbook. It is in the first pinned comment right below this video. Just tap it once and you will have everything you need. Now stay right here because the last rule is the one that is quietly costing seniors the most money of the 3, and most never see it coming. That is exactly why I made this whole video. Rule number 3, the fraud liability shift. Here is the misconception. People believe that money in a federally insured bank account is protected against fraud loss in the same way it has always been. FDIC insurance covers bank failure. That is real and it is intact. But FDIC insurance does not cover fraud. Fraud liability is governed by your account agreement and by federal regulations under the Electronic Fund Transfer Act, specifically Title 15, United States Code, Section 1693, and the terms of that liability have been quietly restructured in the account agreements of most major institutions over the past 4 years. Here is the scale of what the FBI is tracking. According to the FBI Internet Crime Complaint Center, American consumers lost $7.7 billion to fraud and cybercrime in the most recently reported year. Over 200,000 complaints were filed. The average loss per victim was $38,000. More than 12,000 cases involved losses exceeding $100,000. And the demographic that accounts for the highest per victim dollar loss is people aged 60 and above. That is not a coincidence. It is a target profile. The people most likely to hold a decade-old savings account with a larger than average balance and the least likely to have reviewed their account agreement in the last 5 years are precisely the people that fraud operations are designed to reach. Here is the specific liability shift that most people do not know about. Under the Electronic Fund Transfer Act, if you notify your bank within 2 business days of discovering unauthorized activity, your liability is capped at $50. If you notify between 2 and 60 days, liability rises to $500. If you notify after 60 days, you can lose everything that was transferred after the 60-day mark. The critical word is discovering, not when the fraud occurred, but when you discovered it. For retirees who check statements monthly or quarterly, the discovery clock may not start until weeks after the fraudulent transfers began. And here is what banks quietly changed in their account agreements starting around 2020. Many institutions added provisions stating that certain electronic transfer authorizations, specifically those that include any form of account owner interaction, however minimal, Shift the liability burden from the institution to the account holder. If a fraudster calls you, manipulates you into providing a one-time code, and then initiates a wire transfer, the bank's position in many updated agreements is that you provided authorization. The Consumer Financial Protection Bureau has documented this liability shift and has issued guidance, but the guidance is non-binding and the account agreements are enforceable. Consider a woman named Rosemary. She is 67, a retired elementary school principal from Baton Rouge, Louisiana. Last year, Rosemary received a call from someone who identified themselves as her bank's fraud prevention department. They told her her account had been accessed by an unauthorized party. They walked her through a verification process that included reading back a code that appeared in a text message. The caller used that code to authorize a wire transfer of $22,000 out of her savings account. Rosemary called her actual bank the next morning. The bank reviewed her account agreement and informed her that because she had read the code aloud, a code sent to her phone as part of the transfer authorization, she had provided consent under the terms of the updated agreement. Rosemary did nothing wrong. She believed she was talking to her bank's fraud department. She was following instructions to protect her account. That is the liability shift in real terms. Here is what that means for each group. For the lower-income retiree, the fraud exposure is proportionally catastrophic. A $20,000 loss on a $40,000 balance is a retirement-ending event. For the comfortable retiree, the exposure is larger in absolute dollar terms. And the bank's updated liability language means the presumption now runs against the account holder in disputes involving electronic authorization. Here is the specific statutory protection most people have never used. Under Title 15, United States Code, Section 1693, you have the right to request in writing that your bank provide the complete liability terms applicable to your specific account, not the general disclosure but the terms governing your account. You also have the right to submit a written dispute within the regulatory window, and that dispute must be acknowledged in writing within 10 business days under federal law. Most people who lose money to fraud never file a written dispute. They call the bank. The call is not a formal dispute. A written dispute is. There is a simple habit that closes off most of this exposure before it ever starts, and it costs nothing to put in place. If anyone calls claiming to be your bank, hang up and call the number printed on the back of your card or on a past statement, never a number the caller gives you, and never by pressing a call back button they provide. A legitimate bank will never ask you to read a one-time verification code aloud over the phone because that code exists specifically to prove you and only you are the one authorizing the transaction. The moment someone else asks for it, the purpose of the code has already been defeated. This one pause, verifying independently before acting, is the single habit that breaks nearly every version of this scam, regardless of how convincing the caller sounds. You will never be told to file it in writing. You will never be told the 60-day discovery window controls your liability. You will never be told that reading a verification code aloud has been reframed in your account agreement as authorization. That is the third rule, and that is the most dangerous one. Here is the closing action checklist. 5 steps. Do these in this order. Step 1. Audit your savings account yield. Go to FDIC.gov and search FDIC national rate caps. Find the current published average for savings accounts. Compare that number to your account's current annual percentage yield. If your yield is below the national average, you are in the lowest return tier of an already low return product. Write the gap down. Step 2. Request the written fee schedule for your specific account, not the brochure available in the branch. Call your bank and ask for the current fee schedule attached to your account number in writing. Ask specifically about maintenance fees, minimum balance thresholds to waive those fees, inactivity penalties, and any fee changes made in the last 36 months. Request this in writing so you have a dated record. Step 3. Locate your most recent account agreement and find the section labeled Electronic Fund Transfer Liability or Unauthorized Transfer Liability. Read specifically the language around authorization. If that section references customer interaction or customer-provided codes as a basis for transfer authorization, you are operating under the narrowed liability terms. Photograph that page and keep it. Step 4. Verify your fraud reporting window. Check your account agreement for the notification deadline language. Federal law under Title 15, United States Code Section 1693 provides the baseline protections, but your agreement may have modified the discovery window interpretation. If anything in the agreement language conflicts with the federal baseline, contact the Consumer Financial Protection Bureau at consumerfinance.gov and file a written inquiry. Keep a copy. Step 5. Set a calendar reminder for 90 days from today to review all 3 of these items again. Banks are permitted to update account terms on a rolling basis. The 60-day notification window built into most agreements means a change mailed today is enforceable in 60 days. Whether you read it or not, you followed every rule they told you, you saved, you kept your money in a federally insured institution. You did not take risks. The rules changed around you without a single phone call, without a single letter that explained what changed or why, and without any legal obligation on the bank's part to make sure you understood the new terms. Now you know, and knowing is what the closing checklist turns into action. If this helped you make sense of your own accounts, subscribe for more breakdowns like this one every week. I will see you in the next one.